Welcome to Friday Focus, where ideas ignite in the world of business shining bright. Each episode a journey profound as we...
Thanks for joining our second episode of Friday Focus. I'm Pincus Schiff, your host, co-founder at Friday. Joining me today is Jacob Oberlander, certified public accountant from Oberlander & Co. Jacob, why don't you introduce yourself to the audience?
Hi everyone, my name is Jacob Oberlander. I'm the founder, CEO, team leader at Oberlander & Co. I have been doing accounting since as long as I can remember. I have run Oberlander & Co for the past 12 years. We're a boutique accounting firm focusing on accounting, tax, and CFO/advisory services.
Beautiful. Thank you so much for joining us today. We're diving into a very interesting concept. It's year end and dealing with accountants a lot, especially being a lot involved in the accountant community. I've seen throughout the years a lot of different strategies that accountants implement. And obviously there's the proactive approach where accountants come in and not at the end of the year, they start January focusing on the future. But at least now when it comes year end, most of our audience is small business owners, and I'm sure you have a good accountant, but there's sometimes concepts that get forgotten. People overlook certain things. So today we're going to dive into 5 very unique concepts, how people save money on taxes. Jacob, first take. I've seen a ton of tax saving tips, and I know you probably want to give a disclaimer to the audience. So let's go right into that.
What I would say is my disclaimer would be whatever we're discussing now is for informational purposes only. Whatever we're going to do, we're going to try to give you simple examples. These are stuff that you can implement, easy to understand, but still I would encourage you to consult with your accountant. And what you need to understand, whatever we're going to discuss today is perfectly legal, 100% legal. You need to understand the difference between tax evasion and tax avoidance. Tax evasion is illegal. That's when you commit a crime. Tax avoidance is perfectly legal. I would say it's not only legal, it's your obligation as a breadwinner to your family to pay as less tax as possible. So there's nothing wrong about trying to save money on taxes. This is the American way. We try to do that, but as long as it's legal. And always, whenever you have a question, am I doing something that's legal or not? There's a sniff test. What I try to tell clients is think of it as sitting the opposite of an IRS agent. And they ask you a question. Can you answer that? Do you have proof? As long as you can answer that comfortably and you know that you did it the right way, then go for it. That's the way you should do it.
I totally get it. The IRS has common sense too. Not everything is, there's a lot of laws, there's many different tax laws, but people should understand that they're human. You're going to sit with a person if you get audited and you have to explain to him. And it's not like you're talking to a robot or some tax genius. You're talking to a regular person. Okay, so I've seen.
I would ask one small thing. We're going to touch just to scratch the surface. We're not really going to go into very deep, but this will give you an idea. Some of the items you can implement right away. Some of that is a little deeper, but hopefully you'll get a good understanding on those topics that we're going to discuss today.
Awesome. Let's dive in. I've seen this the first time on TikTok. And yes, I've seen it all over, and I actually get a lot of questions about Friday itself, if we can process payroll for kids. A lot of small business owners hire their kids for their small business, and you pay them a salary. So I would like to understand 2 things. So first of all, that's for sure. Just saying that you're hiring your kids, it doesn't work. So if you have a small business, there's certain jobs that your kids can do, and obviously extremely important. My son, I try to educate him as much as possible, bringing him into real life business. Again, we're in the tech space. It's really hard. But if you can bring in your kids into your business and build it up as a family business, if you want to leave a real legacy, it's time to start when they're young. So hiring kids, how does it work? And obviously there's a couple of questions that I have on this. It is perfectly legal, although they're underage. Give me a little bit of the details, the context, how it works.
Yeah, so you mentioned TikTok. So normally you should not get your advice from TikTok. This is actually a rare exception where the concept is correct that you could hire your kids, and we're going to discuss it now. But there's a lot of details involved. In practicality, it doesn't really happen that often, but it does. We have, we have set up clients that hire their children. So let's discuss the topic. So I'm going to use an example. Let's think you have a daughter. She's 15 years old, and you want to hire her. You want to learn, teach her, like I said before, teach her ethics, how to work properly. She has a lot of extracurricular activity that she wants to do. A lot of kids have banking lessons, dancing lessons. They want to spend money. You would want to give them pocket money. You want to teach them work ethics, and of course, you want to save on taxes. Can you do that? The answer is yes. You can do it 100% legally, as long as your child works for you. So your daughter, in this example, your 15-year-old daughter, she comes to your office every day after school. She does. She stuffs envelopes. She cleans the office. I have seen some young adults, older children, doing the light bookkeeping, invoicing, making some phone calls. So that's 100% legal, and you can do that. Now, how does that work? The way the tax code is set up, there's a concept of a standard deduction and itemized deduction. Remember that for later. We're going to come back to that. A standard deduction for a child is $13,850 for 2024. What does that mean? That means that your first $13,850 is tax-free. You're not going to pay a penny on taxes on that. If your child files a tax return, they can file it legitimately. They put it, they get a W-2 from you, they file a tax, they're not going to pay a penny of income tax. Best of all, not only are they not going to pay any income tax, they're not going to pay any Social Security. If you look at your pay stub, there is income tax, there is Social Security,
Medicare.
Per the IRS, as long as your child is below the age of 18, they're not going to pay none of that, no Social Security, no Medicare. The way their pay stub will look, there will just be a gross number. As long as it's below, their W-2 will look just a gross number, as long as it is below $30,850. Now, so your child works for you. They're getting their paycheck. You're getting a 100% legitimate tax deduction for that. That's beautiful. That's the way it works. So let's assume that you're in a 25% bracket. On that $13,850, you're saving, on every dollar, you're saving 25%, right? In this example. So this is a beautiful way to help you save on taxes and help your child save on piano lessons or whatever they want. Now, why doesn't it? So this is actually perfectly legal. I'll just say that in reality, there is a cost involved for setting it up. So let's be realistic. You have to set up on payroll. They're going to get a check. You have to keep a log. You have to keep time. You want to set up regularly. You want to be able to, what we call audit prove it, right? They're coming in, they're doing the work, they're doing some extra work. And so you have to set up payroll. And so there's accounting payroll cost involved. So it's not always cost effective. Can I do it? It's not always cost effective. It's not always the savings, but oftentimes it does.
Got it. So is there a limit to how many kids you can hire?
There's no limit how many kids you can hire, meaning you can hire as many kids as you want, as long as it's legitimate. Meaning to say is, it makes no sense for you to say is, if you are a one-person office and you're saying is I'm hiring 4 kids, it makes no sense, right? It just you have to be able to prove it and substantiate it. What I was saying
again, if it does make sense and you'll be able to prove it, go for it.
Right. What I would say is there's a question about age. So per the IRS, you can do it up to the age of 18. Now, how young can they be? There aren't specific guidance how young your kids could be. Typically, what we have seen is people hiring their kids much above the age of 12. There has been a court case where the Irish definitely disallowed under the age of 7. There's not a specific age. As long as you're hiring your kids for a job that makes sense for their age and it sounds right. The other thing that we have to remember is that there are labor laws. You can't just say is I'm hiring my kids to, if you have a fireworks shop, obviously it makes no sense. If you have a auto mechanic shop, you're not going to hire your 10-year-old child.
That's child labor.
Right. So you have to obviously comply. You cannot hire your child. When it comes to child labor law, you can easily find online what the rules are. Typically, the federal guidance will always be a little bit more lax than the state, especially if you live New York, New Jersey, some states. Their rules will be way more stringent than the IRS. So you have to check your state labor laws as well if you can hire a child. And it has to make sense that the child actually does that job. The biggest concern, the limitation of this is that it only works for an LLC and a sole proprietor, meaning when you file on Schedule C, when the owner is the parents, meaning the husband and spouse, the parents of the child are the sole owners of the business. If there are any external partners, this is not going to work. So in many instances, if you have a business with a partner, with an external partner, you cannot hire your child. And it does not work for an S corporation. Many of our clients, many small business clients, they will actually work as an S corporation, so it doesn't work. Now, luckily, I have a workaround for you. The workaround is if you hire your employees through let's call it a staffing agency. Now, if you create a staffing agency, which is an LLC owned by you and your spouse, and they work for that agency, that should work. But that's a workaround, which should work. But again, there's more. This is adding a layer, and it doesn't always. It's not always right. It has to make sense. So you have to discuss with your accountant if it's right for you. But that is a workaround. The same workaround might be. I'm saying might be when you have grandchildren. What happens if you want to hire your niece and nephew? Can you hire them? No, you cannot hire them unless if it's through a staffing agency that's owned by their parents.
Got it. That's interesting. Let me ask you a question. In general, when it comes to tax savings, a lot of people spend money on their business account just to avoid taxes, which is one of the stupidest things. In general, if you don't need it, then you're not saving money because you're spending an additional 80% or whatever on top of that money. So my question to you is like this. When you utilize it, meaning for parents who want to utilize this, are they allowed to put away the money for the kids? Meaning, I'll pay you $13,000, whatever the number is, a year, but I'm putting it into a savings account, an investing account, a college fund. Is that allowed? Or you actually need to give the money to your kids and they spend it whatever way they want? But because for me personally, I would rather save the money and pay taxes on it than getting it to waste.
Right. So the money is your child's money. That, first of all, I would say is definitely there should be a separate bank account. There actually should be a bank account it's called a custodian account. Most banks will give you the option when you go to your bank, you tell them I want to open a custodian account for your child, and that's the way it works. Now, the money can be spent for activity that you would normally spend on your child. We're not talking about tuition. Tuition is because that's your responsibility. We're talking about extra activity that, let's call it money that will otherwise be pocket money for your children. Now, there is a big, if you couple this approach of paying your children and then saving the money, that's actually very beneficial. You can open an investment. You can use the money to invest. More than that, ideally, you can open a Roth IRA. Now, a Roth IRA, which we'll discuss a little bit, we'll come back with a little bit later. A Roth IRA is you put away money in investments and stocks. Let's say you put away, your child earned $30,000. They're putting away the money, they're saving it for retirement, and they're not paying any taxes on it now because they're below the $13,850 limit. The proceeds, if this $13,000, what do you think your 10-year-old child, when they reach retirement age, what do you think the $13,000 will be worth?
I don't know. Got to take a calculator, but a lot of money.
A lot of money. They will get that money tax-free. They're not going to pay a penny on taxes on the capital gains. Why? Because it's a Roth IRA. So you can see this is a very good approach to take. You put away $10,000 now, you save for retirement age, you're going to get X amount of money and pay no taxes on it. So it is definitely a very good approach. Again, not everyone is ready to save money for tax, save away, have your kids. Not every child is ready to save money, but it's definitely a good approach to say this as a type of investment.
Got it. Very, very unique. I guess investing for your kids, and especially a wedding fund or anything that they will want to buy and spend later on.
Right. A wedding fund will not be tax exempt. The only thing that will be tax exempt is going to be a Roth IRA.
A Roth IRA.
It's definitely the only two. If we, as finishing covering this topic, the only thing that I would add is workers' comp. Just like you understand that you have a workers' comp obligation for your employees, you will have the same workers' comp. Your children will have to be covered under your workers' compensation policy. And understand when we discuss filing that you're exempt up to $30,850, that's IRS. Your state. I know a lot of your listeners are New York State, New Jersey based. The limits are lower, Right, the tri-state area. So they're probably your state may have a lower limit. They might be obligated to file a state tax return, even if they're not required to file an IRS tax return.
Got it. Very interesting. Okay, moving on to anything else you wanted to cover on this topic, or we're
I think we covered it. Yeah.
Awesome. Topic number 2, obviously, is charity. For me, as a Jewish person, charity is very important, and in the Jewish community in general, goes back to the Bible. A lot of people give 10% of everything they earn to charity. But charity is a way, it's not a way to save money. It's a way to save money on taxes if you already gave charity. Otherwise, you're still spending 90% or 70% of the money. But if you're planning to give charity and you have a business, you want to set it up the correct way and make sure you benefit the most out of it.
Yeah, isn't it nice that we get to give charity and we like to give charity and get a tax benefit on top of it? The government, they want to encourage people to be, good citizens, right? Right. So the way the tax code, you will see when we talk about a lot of the tax topic that we're discussing, you'll notice that there's a pattern there. The way the tax code is set up, they are encouraging people to do certain stuff. So they will actually sort of reward you for giving charity, because charity is a great thing. It's not always, the government getting involved. If you give charity to a needy person, to an organization that helps other people, then why not? So the way it is structured is that you get a benefit out of it. So let's get a fundamental understanding how charity works, and then we can discuss the unique tricks, how we can make charity work for us. In order for us to understand how charity plays into the tax system, we have to understand that there is let's call it a bucket. When I'm going to use an example, a person earning $200,000 per year. Every person earning $200,000 per year, or any other person, gets what's called a standard deduction. Remember, before we discussed $13,850 for a child. Right. The reason why I said $13,850 because that's for a single person. If you are a married filing jointly, the standard deduction for the coming year is $27,700. So what that means is that there is a bucket of $27,700 that you're not going to pay a penny in taxes. So this person earning $200,000, are they going to pay taxes on every dollar? The answer is no. On whatever is in that bucket, your first 27 and change, you're not going to pay penny taxes. Now, Now the IRS gives you another option, which is called an itemized deduction. It's a different bucket. So you can choose bucket A or bucket B. What is a bucket B? When we talk about itemized deduction, there are the big 3. One is interest on your home mortgage, up to $10,000 of state or real estate tax that you pay, and then there's charity. If your bucket B is more than $27,000, you would use bucket B instead of bucket A. So if your bucket B is $100,000, would you use bucket B, which says a deduction tax-free $100,000, or your standard, which is obviously you use bucket B. So what you want to do is you want to try to set up if you get your itemized deduction, this is where charity comes into play, when you're going to use, so to speak, bucket B. So if you have, now why am I saying this? If you're giving charity $1,000, you're married filing jointly, there's no value to it really, because at that point, and you don't own a house, you don't own a house, you don't have a lot of taxes, then the 27 bucket A is more valuable for you. But when you own your house or you're giving a little more significant amount of charity, this is where bucket B starts to make sense, what we call itemized deduction. So we're going forward, we're just going to discuss a way, where bucket B comes into play. So let's assume you have charity, you have a decent amount. So let's for argument's sake, say you have at least $10,000 worth of charity. You're giving money to charity, you're going to get a write-off. So think of it dollar for dollar. So if your tax bracket is 25%, for every $10,000 of charity, potentially there's a savings of $2,500. 25%. Right. That's the way it works. Now, in order for you to have charity works for you, first of all, it has to be a qualified organization. This is a question people often ask. If I'm giving money to my needy neighbor, my needy family, am I going to get, the answer has to be what's called an approved 501c3. When a nonprofit organization, they want to be able to collect donations and, incorporate as a nonprofit, they have to apply with the IRS, what is known as a 501c3. Now, it has to be an approved 501c3. It could also be a congregation. So typically, when you talk about a congregation, that's typically what we would say is a shul. A nonprofit would be, organizations known in the community, organizations that help people in need. So that's the simplest way of giving charity when you're giving money to charity. Now, there are limitations. I think we should discuss the limitations. What I would say is that this person getting $200,000, wouldn't it help for him to give $200,000 in charity? Will it wipe out his entire income to zero?
Yeah, but he still has to.
The answer is, right. Obviously, it has to make sense. You will get audited if it's excessive. But we're talking about what happens if you do give. What is the maximum limit? Because remember, you can give charity from money and savings. So if you're earning $200,000, in concept, it could be that you have money to give to charity. Will you be allowed, right? And you have to understand, when we're having this conversation, we have people in real estate will technically on a tax return, they will show zero income, but they still earn the income legitimately, and they want to give charity. Will it count? Can they use the charity? The answer is, the charity limit for every year is up to 60% of AGI. To simplify it, I'm just going to call it 60% of the income. I'm oversimplifying I don't want to.
AGI is the average income in the United States.
Adjusted gross
income.
Right. So that's what the IRS considers the income. So it's up to 60%. In other words, in this example, this person making $200,000, he can use charity up to $120,000. That would be 60%. Anything above that, you're not really using it. It's a carry forward. So oftentimes we have a person that gives charity, but for every reason they're not really utilizing it because they don't have a lot of income. Don't be afraid. It creates sort of a reserved fund. Next year, when you have more income, you will get to use it then. You can sort of save it in storage up to 5 years. Okay.
Wow, that's something I never know, that you can save from 1 year to the next one.
Yes,
really cool.
we see it a lot. So you can have a person giving charity this year and they're not using it next year. They're not giving a penny of charity, but they will be able to use it next year. The 60% limit that I mentioned to you has a few, with the IRS code, there's always nuances. So that's why you should consult. If you're giving substantial charity, you should consult with your accountant or CPA. The other limitation is if it's a private foundation. Now, typically we give charity to public foundations, public organizations. That's a 60% limit. If it's a private foundation, then it's only 30% of AGI. If you donate antiquities, fine arts, we will discuss in a minute that there's an approach how you can save taxes doing that. That will be limited to 30% of the AGI. 30%.
So a lot of people I know use donor advisory funds, which basically is an umbrella organization for organizations. Is that any different than regular charity?
Yeah, I'll come to. Let me just. I want to finish up with because we discussed personal. I just want to briefly mention that a C corporation. Typically, when we discuss a charity, most of the listeners are either LLCs or S corporations or individuals. That's what we covered. I'll just briefly mention that C corps can give up to 10%. The 60% limit doesn't apply to them. They have a 10% limit, only up to 10%. If it's a trust, if it's some trust.
Why is that? I guess C corp is
that's the rule. That's just the rule.
It's considered an entity for itself. It's
considered an entity for itself, right? That's the rule. Now, in general, when we talk about IRS rules, some of the IRS rules make sense. You have to understand when it comes to tax, a lot of the laws, some are rational, some are not. And people like to complain on the IRS, but in reality, it's not the IRS making the rules, it's Congress making rules. The IRS is sort of the enforcer. They're like the policemen enforcing the law. So when the Congress decides they want to do something, they can do whatever they want, the IRS has to enforce it. So that's just the way it's designed in the code. We can try to rationalize it, but that's the way it is. For a C Corp, it's going to be 10%, period, on the corporation level. When it's a trust, some trust, that's actually a great approach. Certain trusts will be treated as personal. Certain trusts they can give charity up to 100%. But I'm not going to go into that. That's a little advanced, so we're not going to go into that. Now, let's go back to the donor advice funds, or sometimes you'll see it listed as DAF. So you know it's the same thing. So what is a donor advice fund? And it's actually that we highly recommend. So a DAF is actually considered a public charity, and you can give up to 60%. There's no issue there. Now, why is that advisable? First of all, let's explain to the listeners what a DAF is. A donor advice fund is you're giving charity to organization. It is considered at the time that you making the donation. That's the time that it is considered that you donate money to charity. Later on, so let's say I have a good deal. So let's create an example. I had a good year. I made a lot of money. I had a good sale on this project, and I want to give money. I feel generous. I feel the right thing for me to do is to give money to charity. I have $100,000. If I'm giving 10% master, I want to give away 10%. I made a profit on $1 million. So what I'm doing it, but I'm not sure which charity I want to give the money to. Right. So what I'm going to do is I'm putting the money in a donor advised fund. Now later on, over the years, I can keep the money there as long as I want. And later on, what I can do is I can advise them. So that's the key word. So it's good. That's why it's called a donor advised fund. You're sort of advising them where to give the money to. So in a year from now, you become aware of an organization and you want to help out that organization. You are advising the DAF to give the money to them. So the receipt you're getting in year one, and you're getting the benefits later. Now, why is it beneficial? Number one, it simplifies the whole record keeping process. Charity, there is requirements. So for every charity, you have to remember that for every donation above $250, you will have to keep a receipt. That's number one. Every donation, even if it's smaller than $250, you don't need the receipt, but at least you will have to prove it. Meaning you will have to be able to show on your credit card statement, on your bank statement, that you gave the money. If you give money other ways, so it becomes cumbersome to keep receipts. When we file a tax return for our clients, we would usually ask them, send us in all the receipts. And don't think the IRS is not going to audit you. They do. We have seen charity audits, right? So they will actually ask you, send me in. And we have spreadsheets of, you have to, what I'm telling you is very interesting. People ask, what is the normal amount to give to charity? You have to understand that in our community, the rate of charity is way higher, way higher than the national average. If you're going to look on studies online, I think that the rate of people giving charity are 1 or 2%. The tax returns that we see are 10%, or most of them are at least 10%, and some of them are even higher, right? So when the IRS may look at it, and you want to make sure that you prepare for an audit. Using a donor advised fund is a very good tool, because if I'm going to give, or anyone is going to give $100,000 to charity, you're going to get one receipt of $100,000 per year. Now they're going to distribute the funds based on what you are advising them, but you're going to get one. It simplifies the whole record keeping process.
If you get audited, all you show is one receipt, and you're good.
Exactly.
Cool.
The way you're going to. Okay, go ahead.
I'm sorry for cutting you off.
Sure.
As an advisor in the DAF, in the donor advisory fund, what many people I think don't know is they can refuse who to give charity to. You can advise them you want them to donate money to a specific fund. They can reject it.
Yeah,
you're not in control anymore.
Right, and obviously you cannot get the money back. So it's there's no way of you getting back the money. And what's important to know, and that's actually working in your favor, because when you're giving money to a charity, if the charity is not an approved 501c3, and you don't know that because you can be in trouble. However, when you give money to a donor advised fund, typically they will vet the organizations. They will not hand over any money to any organization that's not an approved 501c3. So they're sort of your back office, making sure that
you're a policeman.
Right. In the old days, if you're familiar with the big private foundations, if a person is a multimillionaire, or now millionaire is with inflation, you have to say billionaire.
Sounds too little.
So they have a private foundation, and they sort of have their own office taking care of the foundation money. But most of people that we work with day-to-day, small business owners, they want to be generous, they want to give charity. They don't have a whole organization, so they're using a donor advised fund sort of as the back office for charitable giving. Now, the way that works, right? So they set it up. They typically charge like approximately 2% to manage your money. Another good thing about DAFs is that you can actually invest the money. So I know Fidelity has it, some will actually allow you to, the money that you contribute to the donor advised fund could be invested in safe investments. So if it's safe stocks, and the money could grow. Obviously the money is not going back to you. It's staying for charitable purposes. But it stays in the fund, but that could grow, and that's nice. The other thing is that's very common is that when you give every morning charity, so we have a lot of people giving dollars, $5, $10. You're not getting any receipt. You don't have any way to prove it. If you're using a DAF to give it, some DAFs have the coupons. That's actually very useful, because this way you're sort of getting a receipt for it, so you will be able to deduct that on your tax.
You get a receipt for every dollar that you give.
Right.
Anything else to add on this topic, Jacob? I know there's a lot, but
right. I am going to brief. Yeah, it's a lot, and let me just briefly mention a few things. Number one, marketing versus charity. This is an important conversation when we're on the topic of charity. Oftentimes we see people spending marketing dollars to nonprofits. So let's say there is a local, in your community, there's a local nonprofit helping people in need. They have a baseball tournament for kids. You are the sponsor. You know, the t-shirts, you're putting your logo on there. The question is this charity or is it part of your marketing strategy, right? So let's say, right, it's a question. The answer is, you have to think what it is. And if it's marketing, if you're giving the money to this organization for marketing purposes, not with a charitable intention, then it's marketing expense. And that actually works in your favor. Why? Because with marketing, it's pre-tax, you don't pay any taxes on it, 100%. And we didn't even touch on that with charity, there is payroll, social security tax involved. But over here, there's no social security tax involved. You can give the full money. So you have to make sure if it's marketing money or charity. So if it's marketing money, then that works even better in favor. So make sure that you are aware of this. That's why we see often some organizations will have journals. If you advertise in a journal, that's advertising, marketing versus charity. And in terms of for tax purposes, that's actually way more beneficial. I'll just briefly mention that there are more advanced strategies with charity. One of them would be CLAD trust. A CLAD is a concept where we see that with people making a lot of money, they're investing money in a CLAD. A CLAD is a charitable trust. It's a private charitable trust that you're opening. You can use the money. So let's say you're putting in $1 million in the CLAD. So typically it's when people make a lot of money. So the IRS will allow you to distribute the money to charity over 20 years, let's say. But you can use them in the meantime, you can use part of the money to invest. So after 20 years, you're still left with your business investment after giving money to charity. I'm not going to go into details, especially this year. A CLAD is not really beneficial. It's not so beneficial this year because of the IRS interest rates, but be aware of that because we have seen in the past people utilizing CLADs, and that's actually for high net worth individuals, it could be a good approach.
Interesting. Very interesting. Okay, we're moving on to number 3. And it's something that a lot of people do, and people put away retirement funds, either through their own funds. A lot of people I know manage their own funds, especially small businesses. A lot of people use advisors. Let's dive in. And obviously, if you're not planning to retire and you're not interested in getting money, it's always still safer to just pay taxes on the money. But if you're using it anyway, you want to put away, you're putting away money for retirement, you want to utilize this for tax purposes. So let's
I always tell people people have an obsession of not paying taxes. So they have they would do moves that are not wise, that are not smart, just not to pay taxes. They will, for example, they will spend money on the business just not to pay taxes. It's sometimes the right thing is just to pay taxes.
Exactly. Take home your money.
Right. So when we talk about retirement, the goal of retirement is the government, as we discussed with charity, the government wants you to put away money for retirement. If you know Social Security that you pay every week on your paycheck, that's a form of retirement. It was created during the New Deal era. So you have to, the government sort of forces you to put away money and you will get it once you retire. On top of that, the government wants to encourage you further. That's just a minimum amount. It's not enough money to live on. The government wants to encourage you people to save retirement, so they will incentivize you. There are 2 ways how the government will incentivize you to put away money for retirement. Let's discuss retirement that are on a personal level, because that's really stuff that you can implement by yourself. You don't need any professional. You could just walk into a bank
company.
It's just
got it. Yeah. Because I'm planning on having another episode just about retirement funds for businesses in general. So
yeah.
To that now.
Yeah. So I'm not going to go into the nitty-gritty details, but I think it is good to have a general understanding. We'll focus more on the personal level, and then we'll just briefly touch on the business level. So on the personal level, there are 2 options: IRA, what is known as a traditional IRA, and a Roth IRA. An IRA works when you put in money. The limit is up to $7,000 for you, $7,000 for your spouse. So it's up potentially we're talking
14,000.
about up to $14,000. You can do it up to the next. You don't have to do it before year end. That's a good thing. You can actually do it until April 15 or your extension date if you file an extension. So you put money into retirement. What the government will say is if you're putting away $40,000 for retirement, the money that you put away is tax-free. It's as if you never earned the money. You don't have to itemize. We're not talking about buckets of itemized deduction, just in and of itself. If you're going to put away money for retirement, that's tax-free. The other option is...
Sounds pretty good.
Yeah, but it's not that good. I'll tell you why. Because the deduction, you have to earn money less than $116,000, and then it starts phasing out. It phases out completely above the $136,000.
So there's not a lot of money that people save on taxes.
So if you are making, if you're earning $200,000, then this option is not available for you. Okay, the traditional IRA. We'll discuss soon how you can still do it, but just on your personal level, if you're earning a lot of money, you cannot utilize this. The other option, which I prefer, and I want people to listen to this because this is way more useful and practical to do, which is called the Roth IRA. Now, Roth IRA is you're not going to get any write-offs right away. So think of it, people like to invest. Robinhood is very popular now, right? Every few years, there's another investment.
There's a new app.
Right, that's popular. So if you're investing with Robinhood, with TD, or any Vanguard, any other traditional investment brokerages, people do that. People like to play around with that. So, but if you're making money, if you're losing money, then that's that. But if you're making money, you're going to pay capital gain tax on when you
that money
sell your stocks, right? So what happens if you're doing what I always encourage people? Why would you open it under your own name? Just open it as a Roth IRA. Why is it beneficial to open a Roth IRA? You're not going to pay any taxes on it. So with a Roth IRA, how does it work? If you're putting, the same $14,000 for taxpayer and spouse, right? You're putting away $14,000. You're not getting the benefit. You're not going to get the benefits now. But if your money grows and you make more money on it, you will not pay a penny on taxes. We briefly mentioned the Roth IRA at the beginning where we talk about children. But the same thing applies to you. If you're putting away money to a Roth IRA and the stocks, increase in value, you're not going to pay any taxes on it. The limit for investing in a Roth IRA is way higher, which makes it more practical and more exciting. It's, I think, 218, and it phases out completely at $228,000. So you see, with the IRA, you're getting the benefit now, but not later. With the Roth IRA, you're getting the benefit later as it grows. Now, these are both, as I said, easy options. Everyone can implement it. What I would caution you is that there is it's meant to be retirement. So if you take it out before the retirement age, the earliest that you can take it out without a penalty would be 59.5 years. The age where you will be required to take out the money is 72, right? If you want to take it out early, there is a penalty, a 10% penalty. So be aware of that. There are some options to take out a loan against it. So consult with a professional about that. There are exceptions where you can take out the money early. Most notably, exception would be when you purchase a house, you can take out up to $10,000. So that's good to know about that. Now, this is all we discussed on a personal level. I think I'm just going to briefly touch how this applies to a business. In business, there are more advanced approaches how you can make retirement funds work for you. There are IRA-based ideas. There's defined contribution plans and defined benefit plans. I'll just briefly mention it. When you set up a SEP IRA, so that's an IRA, but that's on a business level, the limit that you contribute is way higher. It's simple, it's not very complex, it's easy to do. You can put up to 25% of your salary, or 20 if you're a Schedule E filer. So I want people to know this. If you're a Schedule E filer, you don't have to have a full fancy business. If you're a Schedule E filer, you're earning money, you can put away up to 20% of that. Up to I think the maximum amount is $66,000. So you can so when we discussed a traditional IRA on a personal level is up to $7,000 per individual and $14,000 for married filing jointly. With a SEP IRA, the limit is way higher. Now you can even couple that with the 401k, so you can save money for retirement and
save money on taxes.
Right, but this works well with a small business that has the husband and spouse. What happens if you have a team of employees? You have to offer that to them as well. You cannot make it discriminatory. You can set certain guidelines saying you have to work X amount of months until you get eligible for this, but you cannot just say I want to give it to employee one, not to employee B. So that's something important to remember. And I'm not, so I think that's all for this topic. I would just briefly mention something that for big business, there is a unique idea that we do a defined benefit plan, which is a retirement setup. I will just mention it works well when the business owner is an older person, closer to the retirement age, and the employees are younger employees. So this is an approach where you can actually make it work beneficial to the owner, and they can sort of put away a lot of money for retirement. It works well for them, and yeah.
Awesome. Sounds very good. Moving on to the next. Anything else you wanted to add on the retirement for now?
That's all. I think we sort of gave a brief overview. Yeah.
Awesome. Topic number 4, tip number 4, health insurance and HSA accounts. Not too familiar with that, I'll be honest. I did set up a lot of clients with deductions, HSA deductions, and stuff like that. But how do people use it as a tax benefit?
Yeah, so HSA is actually something that I like. It's actually it's a little known secret that people are not aware of it. Before we get to HSA, let's discuss briefly overall the health insurance arena. In the US, health insurance is extremely expensive. It goes up every year. It goes up way faster than the general inflation. So it's very expensive to buy health insurance. It used to be cheaper, and that's when the companies used to offer it as a fringe benefit. Now it sort of became the general practice. But at the time when corporations started offering it, it was like just a fringe benefit, like giving you a cell phone, right? So, but now they're just stuck with it. So when it comes to health insurance, you are a lot of companies offer health insurance, but we're not discussing here about people offering it. We're talking about when you do health insurance as a tax benefit. Health insurance, if you set up right and you offer it for a company, it's 100% tax deduction. If you're self-employed, you're paying yourself health insurance, it's also considered a tax deduction. So you're setting up health insurance. Now, setting up health insurance is very expensive. So I'll just mention that if you want to save on health insurance, you can do it through your exchange website. The state exchange website may be cheaper for you. If you're a small business or you don't have employees. The other option for small business that have some employees and they want to save is a PEO, which is an option. You'll probably pay less taxes if you do it if you pay your employees through a PEO. A PEO is when it's a sort of like an outsourced staffing agency. So because the
professional employer,
right? Because the pool of employees are bigger, then you pay. That's an option that some people consider. The other option, which is fairly common,
I've seen talking about PEOs. I've seen work with hundreds of clients. A lot of them went to PEOs, came from PEOs. If you're planning on giving, the only way a PEO is really interesting, and again, it's my personal opinion, if you're planning on giving health insurance, even if you don't have to, and you're planning on giving it to every single employee, and you're not planning on charging them money, basically, where employees will tell you, hey, I'm not interested, you end up spending sometimes a lot of more money. So before starting with a PEO, even though it sounds good, saving on health insurance, if only one person out of 50 is using it, you're probably going to lose a lot of money. So make sure before that. Now,
So when we're cutting, so now we're getting to another option, which is probably the most cost-effective and simple to do, which is a high deductible plan. You can offer insurance, but set up a high deductible plan, which really means there's very high deductibles, high copays, so it doesn't cost you as much. That's a good way to offer health insurance. The problem with a high deductible plan, and I don't care if it's on a business level or on a personal level, is that you are afraid of copays, you are afraid of high deductibles. What happens high deductible are often referred to as emergency insurance. So if something, God forbid, happens and you have to claim your insurance, you have a high deductible, and what am I gaining out of my insurance? So when we are pairing that with an HSA, it works very well. HSA, so let's discuss what HSA is. So before I continue, I want to caution you, HSA is only available for a high deductible plan. You cannot have an HSA if you have a regular insurance. It only works for the high deductible plan. So if you offer a high deductible plan, you can set up an HSA account. Now, the HSA account is an account where you put in money every week, every month, and the money that's in that account can be used. It's pre-tax, so you're not paying taxes on the money.
Taxes on that money.
Right, it's pre-tax money. And you can use the money in the HSA to pay your co-pays, to pay your deductibles. Now, you can also use the HSA money to pay for over-the-counter pharmaceuticals. Think of it, Band-Aids, contact lenses, right? That's a legitimate
Any medical expense, right?
Any medical expenses. The IRS has you sort of have to qualify it. If you're going to spend it on your grocery orders, then you'll be taxed on the money, and you'll have a 20% penalty on that. But it is a good option. Now, the reason why I like HSA is, first of all, it's not a use it or lose it. So if you put money in your HSA and for whatever reason, thank God you don't have any injury, any
medical expenses,
you can carry it forward for future years. You don't lose your money. You can even use the money. People are not aware of this. You can even invest it. You can treat it like a Roth IRA.
Interesting. How does the HSA account? Where do you open a HSA account?
So there are some banks that will offer it. There are specialty banks that open it. One of them that comes to mind is hsabank.com. Some of them that I've seen before. You can open an HSA if your employer does not offer an HSA account. You can just open it on the individual level. You can open, and then the company can open it. Now, I just mentioned one name. I usually don't like to mention. I'm not saying they are good or not. This is just one option that came to mind now.
Right.
I've seen several, but what you open a pool. What you do is you open an account with them, you put in your information, the money goes into that bank account. You're actually getting a debit card. So when you go to this is another good example. If you don't have, many people don't have dental insurance, you can use your HSA account to pay your dental. You go to your dentist. I have to do some work. You have money. You just swipe your card. You're getting a debit card for it. It's as easy as that.
Very, very cool. Okay, so back to any money that you spent on health insurance in general, or an HSA account is tax free. What about deductibles? Are the deductibles that you actually paid a part of this? So let's say if I have a high deductible, so let's say first $5,000 is out of pocket. On the first $5,000 that I spent on copays,
right?
Is not.
That's on that. No, it's not a business expense. On your business level, it's not a business expense. If you are itemizing. Remember we discussed before about itemizing.
Right.
Health and medical related expenses are considered an itemized deduction. It gets added to that bucket B that we mentioned before. However, it has to be. The problem is it doesn't really practical, because the limit, you only qualify if it's more than 7.5% of the AGI. So if your AGI is $200,000, you have to spend at least $15,000. Only the medical expenses above $15,000 in this example will be eligible for a medical deduction. So
it's something to take into consideration.
Right.
When you set up your deductibles, when you set up health insurance, and if you can set up your deductibles that you shouldn't pay, let's say if your AGI is $100,000, you said the number is $15,000. Yeah, is that the number?
It's 7.5% of AGI.
7%. So if you're earning $200,000 a year, and I think it makes sense to put your deductibles, find the cheap. If you're ready to pay a high deductible, make sure it meets at the same level.
It has to be done through an HSA. If it's not through an HSA, then you're not going to use it. There's no value in practical terms. Very rarely have I seen that a person was able to deduct medical expenses on the personal tax return. I'm not talking about a self-employed person. A person who has a Schedule C. I'm talking about if you're filing your own tax return and just getting an itemized deduction. Why? Because you have to reach a very high limit. I only see with people with infertility treatments or people who have, God forbid, a child that is sick and they have the medical expenses are so high out of pocket. That's the only way where you actually see it being used. But otherwise, if you spend a few $1,000s out of pocket, you're not going to be able to utilize it.
Yeah. Got it. Anything else you wanted to add on the health insurance topic?
I'll just add the limits. The limits for a family is you can put away every year. The new limits, I think for 2023, for a single is $3,850. For a family, it's $7,750. So that's the limit that you can put away every year.
Got it. Very cool. Next is obviously real estate. We should have done this first, but it is very popular, very common. People have been doing this for years, including our previous president. And all presidents probably, and almost every wealthy person that I know has been utilizing this. So let's dive in. We'll give it a little bit more time, and let's see if we can cover the topic a bit.
Yeah. So I don't think we can have a full session on real estate. So we will not have it. So real estate. We all know people in real estate that are not paying any taxes, like you said, the previous president. Now, how does that work? How is it possible for a person in real estate not to pay any taxes? If a person has real estate as their full-time job, normally at the beginning, they might not pay a penny of taxes. Why is that? Because let's say you have a property, and let's assume that your cash flow, your net cash flow, so you have rental income and you have expenses, your net cash flow is $10,000. So you would think on this property, you will pay taxes on the $10,000 profit. The answer is probably, most likely, you're not going to. Why? Because there is depreciation and amortization expense. Depreciation is when the property decreases in value, and the IRS will allow you to take a loss every year on that. Now, so what we're seeing here, in terms of cash flow, you're profitable, but in terms of on the books, right, per the IRS, you're showing loss. That's why you're not going to pay taxes. Now, I have some good news for people not in real estate. At the end of the day, they will, it will caught up to them. Meaning to say is they will end up paying taxes, but it's not forever. But that's the way you can sort of structure that it should continue for years to come. But if you're just buying one property, eventually you will end up paying taxes on it. So it's not like you will have tax free forever. So that's the idea of real estate. Now the question is, how can we all benefit from real estate? How can we all make it to work in our favor? It's important for us to understand that when it comes to real estate investment, there are 3 levels. You can have an investment in a property where you have no involvement whatsoever. There's something that's known as a real estate with active participation, and then level 3 is a real estate professional. The key here is you want to be able to be eligible to be the real estate professional. So when you buy one property, so why is it important? There is a concept which is known as when you buy real estate, in general, when you have income, there's a concept which is it passive income or non-passive income? Now, what do I mean by that? I think it was in 1987, the government passed a new law. Until that time, if you work on Wall Street, you're making $400,000 on a W-2, you have a nice wage, you have a lot of extra money, you're buying real estate. You're buying real estate and you're depreciating it. You're showing on that real estate deal a loss of $400,000. What you were able to do is just wipe it out, just pay no taxes. Congress decided to put a stop to it, and they said no, it doesn't work that way. If your income is greater than $150,000, you will no longer be able to apply your real estate losses against your ordinary income. So real estate is considered passive. You are no longer able to apply passive losses against non-passive, right? So that's the idea. That's what they implemented. So real estate by default is considered passive. The burdens are you to prove otherwise. So if your income is $100,000 and you have real estate losses up to $25,000, you are still able to apply it if you have some active participation. But if your income is greater, it completely phases out about $150,000. So if your income is more than $150,000 and you have substantial real estate losses, you are not eligible to apply it. The only way that you can utilize the real estate losses is if you have a regular business. And so the only way is if you're doing real estate full-time, because when you do real estate full-time, in essence, what happens is your real estate becomes your non-passive business, right? Income. That's your business. And that's what is known as a real estate professional. You become a
That's why it covers you can use the losses against your gains. Got it.
Right. Now, real estate professional is not something that you print out a business card and you call yourself, John Doe real estate professional. There are specific IRS requirements, and there have been court cases and audits involved. So there are very specific rules. So you have to carefully consider this. A real estate professional is an actual election that you're making with the IRS. And I'll briefly mention the main items. It has to be your main business. You have to put in more than 750 hours per year. So think of it as if a normal person works 2,000 hours per year, I think if you work 40 hours per week, it comes out to 2,080 hours. Right. So you have to put in 750. So we're talking about here about a third of your time. So number one, you have to make sure that a third of your time goes to real estate, and it has to be your main business. Now, if you have one house, one project, you're not a real estate professional. If you have 2 apartments, you're not a real estate professional. And people ask, "Can I be a real estate?" No, it doesn't work. If you have a big business, if you have a manufacturing facility doing the revenue of $10 million per year, and you have a few projects inside, that's not a real estate professional. So it has to be your main job.
You have to really be in the business in order to make it work.
Now, the place where I've seen working it great. So what happens if you have a business, with the $10 million revenue, you're working 40 hours a week and not doing real estate? Is there a way to utilize real estate? The answer is no. But what we have seen is what happens if your spouse is a professional. So you have one taxpayer who is actively involved in a business, the spouse solely works in real estate. So taxpayer 1, business, which is obviously non-passive. Taxpayer 2 works
Massive.
2,000 hours a year in real estate. They can be classified. Now, once your spouse is classified as a professional, you can sort of combine those two. You can sort of use them one against each other.
Got
So
it.
that's actually very beneficial. So one advice for you is, if you want to go into real estate, either do real estate or a business. Don't do both, because you'll end up losing out.
Or just you do whatever you want to do and make sure your wife is in the real estate industry or your spouse, and then you're good to go. Got it. Anything else to add on the real estate topic?
Once we get to real estate, there are a lot of clever ways to save on taxes. For example, when you sell a property, there's a 1031 idea, right? You could sort of swap the quote unquote exchange it to another property. When interest rates are low, people used to do, now interest rates are high, so it's not really very beneficial. But when interest rates are low, instead of selling properties, you can sort of cash it out and use the money to buy new properties. So there's a lot of clever ways how you can make real estate work for you, tax-free, and there's a way to get more depreciation. So it's a really fun and advanced topic. But I think that's.
But I think it's a fun. It's an interesting thing for someone who is really in the business. But in general, people don't. If you're not in the real estate business, there's not really a lot of ways for you to utilize it, I assume.
Right. And again, what we mentioned before, don't just buy real estate for the sake of not paying taxes. That shouldn't be your main focus. It's not going to work in your favor. We have seen people making bad real estate deals. So it's not just, I'm going to buy a property. It has to be the right property. Consult with with a professional, with someone who has experience in real estate.
Exactly. You try to make money. That's the main.
Yep.
Awesome. Jacob, thank you so much for joining us today. And thank you all for tuning in. And looking forward for our next episode of Friday Focus. And see you guys again.
Okay. Thank you, Pincus, for having me.
Thank you.
It was a pleasure. The time went by very fast. If someone wants to reach out to me, probably the best is through LinkedIn or to our website, oberlander.com. Have a good day.
Awesome. Thank you so much, guys.
Bye-bye.
See you again.